In this video, I will talk about imbalance, or fair value gaps on the chart. We will also discuss what CB and BC are, an inversion imbalance, the difference between an imbalance, a volume imbalance, and a gap, and how to use all of this in the market. The first thing we are going to look at is what a fair value gap, or a regular imbalance is. It is a three-candle pattern where the low of the first candle is not overlapped by the high of the third candle. If we mark the low of this candle and extend it to the right side of the chart, and do the same with the high of the third candle, we will see that this high does not overlap with this low, and this is a fair value gap. This all works exactly the same with bullish candles, but if the wicks of the first and third candles were overlapping the second candle, then we would see that there is no gap here, meaning there is no fair value gap. And here, everything is completely analogous. Let's look at a few examples of how to find an imbalance on the chart. If you look right here, you will see that there is a gap between the low of this candle and the high of this candle, and this creates a fair value gap. Now, if you've noticed, another gap has formed, because the low of this candle is not overlapped by the high of this candle. But now, we are seeing aggressive movement in the opposite direction, and if you look at this candle right here, the high of this candle is not overlapped by the low of this candle, which creates another fair value gap. On some people's charts, you might see an imbalance also marked as CID or BSE. CID means that a sell price was offered, but a buy price was not offered, a bearish fair value gap. BSE means that a buy order was placed, but a sell order was not. So, this is a bullish gap. Personally, I don't label it that way. I mark a bullish imbalance with one color and a bearish imbalance with another. And on the chart, it looks like this. We have a bearish move, so this imbalance will be labeled as CB. And here we have a bullish move upwards, so this imbalance will be labeled as BC. How can an imbalance be filled? The first is just a touch of the imbalance and continued movement with the trend. The second fill is a partial fill of the imbalance's midpoint. If we apply the Fibonacci tool, the price would reach the 0.5 zone. And the third fill is a full fill, meaning a complete fill. Once the price fully fills the imbalance, that imbalance is no longer considered valid. And if the price only fills it by touching it or at the 0.5 level, then this imbalance could potentially provide a reaction in the future. How can you know to what extent an imbalance will be filled? It's impossible to know, as the price might only touch the imbalance and react, or it could fully fill this imbalance. If the price is on a higher time frame, for example, on the daily or weekly chart, and the imbalance is large, it is quite possible that the price could react to the imbalance from its very beginning or from its midpoint. That is, it won't need to fully cover this imbalance to provide a reaction on a lower time frame. There also exists an inversion imbalance. What is it? This is when, for example, we had a bearish imbalance, but the price showed no reaction to it. And the price broke through this imbalance, thereby creating another imbalance, but this time a bullish one. And in this area, we have both a bullish and a bearish imbalance. This entire structure is called an inversion imbalance. The last thing we will look at today is the difference between a volume imbalance and a gap. We have already discussed what an imbalance is. A volume imbalance is the gap between the closing price and the opening price of two candles. The difference between a volume imbalance and a gap is that a gap signifies a complete absence of trading between two candles. So, how do you use these imbalances? Roughly speaking, an imbalance is your zone of support or resistance. This happens because the fair price is located within the imbalance zone. This area contains a huge number of buy or sell orders, depending on the direction of the movement. For example, I use an imbalance when the price on a higher time frame has entered a zone of interest or has taken out liquidity on a lower time frame. Subsequently, it creates a trend break, and if we apply Fibonacci retracement, there might be an imbalance within the discount zone, and I will enter a position precisely from this imbalance. And is there an order block above? Should you enter from the imbalance or from the order block? In reality, the price reaction can come from either the order block or the imbalance, so the decision is ultimately yours. It's also important to consider that if an imbalance is visible on a higher time frame, for example on the daily, and we have an order block on a lower 4-hour time frame, then it might seem we can enter from this order block. But in reality, that's not the case, because we have the imbalance above us, and this order block will act as liquidity. As you can see, the reaction came from the daily time frame imbalance, and the price only touched this imbalance, which was enough to trigger a massive downward reaction. Another example, we have an imbalance on the 4-hour chart. We also have this low, which will act as liquidity because below it lies the fair value, which is where the market will aim. Remember, you must use imbalances in the direction of the trend and always look at the higher time frame, as the higher time frame will always take priority over the lower one. How do you use an imbalance with the trend? Right here, we have liquidity. You can learn more about what liquidity is on my channel. We see that on the lower time frame, the price is moving towards this liquidity. Accordingly, in the discount zone, we should look for an imbalance. This imbalance will act as a support zone for the price, and the price will bounce off this imbalance because all the algorithm did was push the price into the discount zone and fill the orders that were sitting within the imbalance. Then the price started moving towards this liquidity. Next, we see that the price is taking out the liquidity from the high of the lower time frame, but it hasn't yet reached the main liquidity. And an imbalance has also formed here. Accordingly, this imbalance will act as a support zone for the price. After filling the imbalance, the price will head towards the liquidity zone of the higher time frame. We see the same thing here. We have a bearish trend. The price is breaking lows but not surpassing highs, and we can use the imbalance as an entry point. And here's how you should not use an imbalance. We can see that we have a downward movement, but at a certain point, the price broke the trend structure. After this, we cannot consider short trades. We should only consider long trades and focus only on bullish imbalances. In this case, the bullish imbalance will serve as the entry point, and the bearish imbalance located on the left side of the chart is your take profit level, as the price will move there to fill the orders. Here we have a gap on the dollar index that I expected price delivery precisely to this gap. After the price reached the gap area, all the algorithm will do is balance the movement that delivered the price to this gap. Next, you see that there is no trend break on the 4-hour chart, and an imbalance is located in the discount zone. Accordingly, the price will correct precisely to this imbalance to fill it, and then continue moving with the trend. If the dollar index rises, then the euro-dollar will fall. Accordingly, I would consider the scenario where the price on euro-dollar enters this daily imbalance, and after that, the price continues to move with the trend. Volume imbalance. You can very often see volume imbalances on indices, and essentially it is the same imbalance. It can be used as a zone of resistance or support. You can look for short trades on a lower time frame after a trend break, and when the price approaches this zone, it will act as a resistance area, but only if you are following the trend. In this video, I have mentioned frequently that you can use an imbalance as a zone of support or resistance. However, this does not mean you should place your stop loss directly within this imbalance. The imbalance is your liquidity or your entry point. And remember, the imbalance on the higher time frame always takes priority. Furthermore, if any low or high is located within the area of a higher time frame imbalance, that low or high will act as liquidity, because the price will strive to fill that higher time frame imbalance. If you are entering your position at an imbalance, it is best to place your stop loss beyond the order block. Using a stop loss within the imbalance carries significant risks, and the choice is yours, to use the imbalance as an entry point or to wait for a reaction at the order block. Also, note an interesting phenomenon. An imbalance can act as a zone of support or resistance after the price has filled it. As you can see, the price broke through and filled this imbalance. Here, it acted as a support zone. Then the price declined into the imbalance again, and it once again provided support. Once the price broke below this imbalance, it later returned to it and touched it again. And again, you can see that it now acts as a resistance zone for the price. However, I actually don't recommend using the same imbalance repeatedly over a long period, as very often after an imbalance is filled, it will no longer act as a zone of interest. I hope this video was helpful and that you will like and subscribe to the channel.